very good morning to you. Welcome to Business Morning. I am Bisi Adebayo. Oil prices are down more than 2% this morning, and that's on worries about slow demand growth with coronavirus cases rising, U.S. crude stockpiles hitting an all-time high, and the U.S. Federal Reserve projected recovery from the pandemic will take years. U.S. West WTI crude futures erased gains from Wednesday, falling as low as $38.42 a barrel, and Brent crude futures fell 2.2% to $40.81 a barrel, also giving up gains from Wednesday. U.S. crude inventories rose unexpectedly by 5.7 million barrels in the week to June 5 to 538.1 million barrels, and that's a record as imports were boosted by the arrival of supplies bought by refiners when Saudi Arabia flooded the market in March and April. Data from the Energy Information Administration showed at the same time gasoline stockpiles grew more than expected to 258.7 million barrels. Distillate stockpiles, which include diesel and heating oil, rose by 1.6 million barrels, but the increase was smaller than in the previous weeks. Meanwhile, global ratings agency Moody's Investors Service recently predicted that lower oil prices will lead to materially larger deterioration in the oil exporters' fiscal and external balances, but expects policy adjustment capacity to determine countries' ability to manage the shock. The service attributes the anticipated weaknesses to the coronavirus pandemic, which has locked down nations and trimmed oil demand across the globe, as it expects the event to worsen sovereign credit. Nigeria is seen as a lower-rated sovereign among peers such as Papua New Guinea, as well as Trinidad and Tobago, and is expected to experience fiscal and external balance deterioration directly as a result of lower oil prices. The head of portfolio management at Commercial Partners Asset Management, Victor Aluyi, joins us now to analyze these projections. Good morning, Victor. Thanks for joining us on the program. So tell us, what are your views about the 68-page report from Moody's Investors Service? It doesn't seem to present so much of a gloomy picture for Nigeria when compared to other sovereigns.
Well, so clearly for Nigeria, external balances and our budget balances still seem quite decent. So that's the reason Nigeria seems to be in a better position than other hydrocarbon exporters like Iraq and Oman. But on average, the agency expects a deterioration of about 2.7% on the budget deficit side, particularly for hydrocarbon exporters, and about 3.9% on the external reserve side. So clearly, the expectation that crude prices are likely to stay lower for longer will certainly have that significantly negative impact on hydrocarbon exporters, particularly from their budget deficits and as well as their external positions.
Service had revised its oil price assumptions further downwards to account for the deeper and the longer-lasting shock to global oil demand, and that's as a result of coronavirus pandemic. But it now assumes that Brent will average at $35 a barrel this year and $45 per barrel in 2021. But just how feasible is this forecast that doesn't seem to align with that of the local authorities?
I think the feasibility of this, renewed, revised forecast, particularly by the agency, would basically rest on what happens with, the coronavirus situation going forward. If we have, another wave, it's clearly going to be significantly negative. Again, we're seeing some semblance of a recovery, particularly on that demand side. However, if you look at demand destruction that we have seen, anywhere around 29 million barrels a day, the supply adjustment that we have seen is just slightly shy of 10 million barrels a day. So there's still that gap, clearly. So I think that, revision, if you will, particularly for the medium to the long term, I think is pretty much realistic. And I think that, the local authorities are also sort of adjusting, their own projections in line with that. We've seen, the benchmark for the budget that has been, revised significantly downwards for what we had earlier on in the budget proposal. So I think there's some, realistic alignments, particularly on the part of local authorities, looking at the reality of the situation, not just for now, but even going forward into the medium term, what we're likely to see crude prices stay around, the $40 to $45 band over the medium term. So I think that local authorities are realigning their own projections in line with these realities.
Talking about the local authorities now, Victor, just yesterday we heard the GMD of the NNPC, Mr. Mele Kyari, asking oil producing companies to brace up for a cap of about $10 per barrel worth of production cost against next year. How does such a policy align with the reality of Moody's projections?
Well, I mean, it's always been kind of tough to get, proper data on, cost of production, particularly for our crude grades. At $10 a barrel, I'm not sure how that will be achieved. It remains to be seen in terms of the details, the modalities, structure, and even framework that will be put in place to ensure that there's this sort of significant drop in the cost of production. I mean, if that happens, it will certainly bode well for the nation, both from a fiscal standpoint and also from an external position. From my own perspective, it really remains to be seen how that would be attained.
But the whole lower for longer oil price environment is now expected to weaken all oil exporters' fiscal and external positions. Now, what are the policy adjustments that authorities should be considering to tackle this?
I think those adjustments are already sort of taking place, if you will. Conversations are being had around that. So the easiest thing you can do is to basically cut spending. We've seen various revisions of the 2020 appropriation bill proposal. We've seen, government looking to cut down on expenditure in different places. And I think that's the easiest thing to do, really. Once your revenues are being threatened, you want to cut down on your spending, particularly for Nigeria, where the revenue base remains largely narrow. It is important that government is able to, one, cut down on expenses, and two, where possible, be able to expand that revenue base. These are some of the policy maneuverings that government can take to try and, weather this storm as it is, really.
This brings me to the part talking about the debt burden forecast. Now, of course, Moody's says that this is likely to increase materially and impact countries with buffers. This is true of Nigeria, which, of course, already has exhausted its excess crude account. But how effective are the measures taken by the fiscal and monetary authorities to address these shocks?
Well, so a lot of the measures that we have seen so far, particularly from the Apex Bank, especially on the external account side, to try and protect those reserves, we've seen that sort of bear some fruits over the last month thereabout. We've seen reserves sort of increase. There's been some accretion to reserves. Also, the recovery in crude prices, if this trend is sustained for another couple of months, although there's usually a lag in that external reserve number, we are likely to see even further accretion to reserves. So that should help, assuage the potential impact of this, drop that we had seen in crude prices. On the fiscal front, really, we've seen some reduction in the budget, but I don't think that is really significant to help reduce, government spending and help, save in that way. However, I think the other areas that the fiscal authorities could explore would be to widen the revenue base as it is right now. Again, given the fact that, we just are coming through the throes of the coronavirus pandemic, it might be difficult to implement or enact policies that would, seek to increase government revenue through other means at this time. Because again, you have to be sensitive to the plight of businesses and the plight of individuals. So it's a really tough, balancing act. But I think the key thing that government can easily do, the low-hanging fruit from our own perspective, is, for some reduction in spending in certain areas that are not extremely necessary. There should be some reduction in those areas, really. That's my view there.
But how much of support can Nigeria's external reserves actually enjoy from the recent rally in oil price?
I think it will continue to, support, the reserve position, really, because if you look at the recovery, if you look at where crude prices are coming from their lows early in April, you're essentially seeing over 100% movement upwards. The question really is whether this will be sustained or whether this can hold for the medium term, so to speak. And if that happens, we should see some, decent accretion to reserves. We should see some, improvements on that front. Right now, our reserves are just slightly shy of 36 billion. If these prices hold up for the next couple of months, we should see some accretion, probably approach the 40 billion mark, and that should help, boost our external vulnerability situation.
The Head of Portfolio Management at Commercial Partners Asset Management, Victor Louis, thanks for speaking with us.
Thank you.
And now we continue the conversation on the domestic commodities markets with a research analyst at the financial derivatives company, Temitope Oluwile, who's here with us in the studio. Good morning, Temitope. Thanks for coming on the program.
Good morning, BC.
Well, let's begin our conversation with the latest development in the crude oil markets. Of course, this morning we've seen Brent drop again. It's trading about $40 per barrel. So what's responsible for the price movement?
So when we thought that, the extension of the OPEC cuts will prop up prices, Brent price to maybe $45 per barrel, we're seeing that rather today it's just approximately $40 per barrel. And that's because of the huge record buildup in U.S. inventories. We see that even this week, the American Petroleum Institute and the EIA have agreed, their individual reports agreed together that there was an increase in U.S. inventories. From the EIA was about 8 million barrels, increase, and even the API reported an increase in U.S. inventory. So that has, limited the gains that we should be seeing from, an extension of the OPEC production cuts, and even Libya having to reclose its oil production plan. So we see that has limited the gains, and we're back down to $40 per barrel.
Now, what about the demand for natural gas? Now, there are projections that it's set for the biggest fall on record. What's responsible for these projections?
Yeah, so, since the pandemic started, the hotspot commodity has been Brent, but shifting the spotlight a bit to natural gas, we see that there are projections of a 4% drop in consumption, and that's because the lockdown restrictions limited significantly reduced the commercial demand for gas for power generation and for heating purposes. And even on the residential household side, we see that the winter conditions were pretty mild this year, so that limited demand for heating purposes for households. So that is responsible for the the projection of a significant decline in consumption this year. And we see that natural gas is our second, it's one of our huge export commodities, accounting for about 14% of our export, revenue after oil. So we see that would have a significant impact, and that's just, worsening our external imbalances. You take oil, what's happening with oil, the shocking oil price, we take the, significant decline in natural gas demand, and you see that all of that would significantly affect our revenues and, widen our fiscal deficits.
And talking about our external reserves now, it has actually slipped further to $36.51 billion. What's fueling the decline we've seen lately? Not even the recent rally in oil price have been enough to lift it.
I mean, the rally in oil prices, as we see so far this week, has not really been sustained. I mean, yes, it's better than where we're coming from in April, but there's still that shock to our fiscal revenue, right? So we see that is affecting our external reserves. And even after we had the IMF loan drawdown, that after a while you start to have to, like now, you take from your external reserves into the forex market, because there's that supply deficit of forex in the market. So the CBN is having to intervene. We also have other important expenditures we're having to incur, as this health spending and all of that, and having to support the SMEs and just to ease the shock of the COVID pandemic situation on businesses and SMEs. So that is having a significant impact on our external reserves.
And talking about the forex markets now, of course, we've seen the naira steady at the parallel markets at 455 naira to the dollar.
Yeah, so we see that yesterday it was steady at, we're still about 455 to 457 naira per dollar, right? So that is, I mean, depends on what you call good news. But the stability that we're seeing for now, we will take it, right? But it's still a long way off from where we entered the year at 360 naira per dollar, and we still don't know what will happen, even as there's an increased demand for forex as the airports open, businesses start to open gradually, manufacturing activity starts to pick up. We expect that pent-up demand, even speculative, even the ones that are just demanding for speculative reasons alone, we expect that demand to begin to manifest soon. And if supply doesn't match up with the demand, we'll see that stability will not be sustained.
What's the latest regarding Nigeria's power output? I see some good news there, according to the slides from you guys.
Yeah, we see that, it's above 4,000 megawatts per hour. We're seeing that increase in power outputs, right? But in terms of consumers and, the how we have to pay and the expenditure on power that we're having to, we are seeing that, the NERC is saying that, very soon consumers will have to pay for increase for, will have to pay more for prepaid meters. We're seeing that news, and we're just wondering, there was already the cry of, prepaid meters not the demand, we're not seeing the supplier matching the demand, right? There's that slow down, there's that period, there's that time lag between when you demand for it and when they supply it. So we're seeing and that is not right now. Consumers are, if we're paying for something in the midst of a dwindling consumer disposable income, in the midst of rising inflation, we want to get the services, right? So they need to match up the services with the increased prices that they're demanding from consumers.
So let's talk about prices at the domestic commodities market. Now, of course, we've seen an increase. What's actually fueling the increase?
Most of it we think is artificial because it's the need to compensate for the increased logistic cost, right? You see that there's that rise in logistic costs. There's all these checkpoints. There's everything fueling. There's that interstate restriction. That these things fueling. The logistics is becoming really difficult to take from the source to the markets, right? So that has to you see that producers have to compensate for that increased logistic costs by passing the burden to the consumer. So we're seeing that there's that increase in commodity prices due to these reasons, and for some commodities also because their planting season has commenced, and so there's that supply shortages playing into the prices of these commodities.
So how long are we likely to see the prices spike? What's your projection for the prices in the coming days?
I mean, as we start to ease the lockdown, as we have maybe 2 more weeks of this of this 30 days period that we are in now. So as we start to ease it, as we start to see airports reopen, as long as there are no restrictions to supply, right, we would see that prices should start to taper down. But if there are still restrictions to supply, there's still logistic costs, there's still logistics bottlenecks, we'll continue to see that increase. But I think that as we gradually start to get back to our new normal, as we reopen, as lockdown restrictions are completely gone, we would see that prices will start to taper down.
And so what's your outlook for agri-commodities?
Going forward, I think that agri-commodities it might start to taper down a bit because, lockdown restrictions have eased, but I think that it will still remain stubbornly high. And especially as consumer disposable income dwindles, right, the reduced demand would start to play into prices. And we think that these prices will still remain stubbornly high, and that will feed into inflation, which should be released on Monday. And we're projecting that they will see a significant increase in inflation. But going forward, if supply restrictions are gone with, we should start to see a taper down.
Well, let's backtrack a bit to the prices of oil, of course, talking about the crude oil markets. Now, what direction are we likely to see prices in the coming days? What are your projections?
So I think prices will still be at current levels, which is $40, around $40, $42 per barrel. We don't see any significant changes in the market. We can only hope that demand picks up to a level that, as more countries reopen their economies, we start to see that significant pickup in demand. Without that, the extension of OPEC cuts will really have limited impact on oil prices, but we only hope that demand pickup would start to manifest in oil prices soon.
We can only hope. Temitope Olugbile, research analyst at the Financial Derivatives Company. Thanks for coming on the program. We're still talking agri-commodities when we return in just a moment. Please stay with us. Welcome back. Nigeria's first quarter 2020 merchandise report shows that the value of agricultural goods export was 85.36% higher than the 46.7% value reported for the fourth quarter of 2019. But these numbers could even be higher if the cost of air freight charges are lowered from their current levels. And it's on this note that international trade experts have been speaking on the need to cut down the high cost of exporting agricultural goods in order to reduce the adverse effects on the development and the promotion of the non-oil sector. Now, if this is approved by the federal government, Nigeria could generate increased revenue to the tune of $250 billion in foreign exchange compared to the 126 billion naira recorded in the export value for the first quarter of the year. And joining us now to discuss this development is the Chief Executive Officer of ABX World, Mr. John Okafor. Thanks for coming on the program, Mr. Okafor. It's good to have you here.
Thank you very much. Good morning.
Well, give us a sense of what air freight charges on agricultural commodities actually look like at the moment.
Well, at the moment, it's completely out of this world. It's not something to write home about. And I think it's been the bane of the problem of agricultural export in Nigeria. It's ridiculous.
So when you say it's out of this world and it's ridiculous, what exactly do you mean?
Now, for example, look at it, and to compare with other nations, like Ghana, like Kenya, look at the cost of their air freights, mostly into European nations, encourages the farmer and the production, the aggregators, to produce more. Nigeria is definitely, in terms of, let me put it this way, 10 times higher than that of in terms of government fees and taxes. So, and these are the areas we've worked with the federal government to at least be able to level Nigeria with those two nations. But for now, we are still scrapping. No matter the increase of the output, the figure you just read.
So if you actually look at the Q1 2020 foreign trade report released just a few days ago, of course, we saw the value of agri-goods growing by 85.36% compared to the fourth quarter of 2019. But in spite of the high cost of air freight charges, which you just alluded to, agri-commodities export have also been on the rise. Why then do we need to trim the charges?
For now, we are hawking. We are not trading. We are hawking. We're just like street traders. The reason why you see the increase because of the problem we have in the crude oil industry. A lot of people now start shifting their attention to agriculture. And that notwithstanding. So we are still hawking. We are not trading. Kenya, for example, do about 500 to 600 tons of agricultural export by air freight every night. We can't boast of 20 tons a week. So it's nothing to write home about. So these are part of the issues we discussed during the ERGP program in 2018. We tabled the reports to the federal government, and we're about implementing it right now.
So what will the implementation mean?
What the implementation means is that it will free us, be able to level Nigerian logistic costs to Europe and to other destinations with that of Ghana and Kenya and some of other nations. Okay, for example, take a look at Uganda. Uganda is about 2 hours more flight to Europe than Nigeria. But when you get their product into Europe and Nigeria into Europe, you can't compare the price. So we have been really outpriced in the market because of logistic cost. And if you're looking at agro-allied industry, logistic cost is about 60–70%, starting from the farm gate to the market. And those are the areas we've addressed, and we've submitted the report, and the adoption was done last year through the Federal Ministry of Trade and Industry. And I believe any moment from now, the federal government will come and will approve whatever report we submitted to them.
But are there specific charges on specific commodities that actually need to be reviewed?
No, you don't review the price of the commodities, and those are part of the issues we are discussing with the government. Because now, if you look at prices, most of the prices, the so-called prices, is determined outside the nation, outside the shores of this land. Okay, a farmer here in Nigeria, after laboring and toiling for months and months, then at the end of it, someone will sit in New York or sit in Dubai or London or Tokyo and determine the price of what you are doing here. Those are part of the things we have to put a stop to. And I think that's what got additional in trouble with most of the so-called civilized, developed world. They want to keep us under that siege, and it's coming to an end.
Hopefully. And lately, analysts have also argued that it's time that Nigeria begins to export more of finished goods rather than actually, take it out and then bring it back as finished goods. What do you think about that?
Okay, yeah. Look, take, for example, in Côte d'Ivoire, for example, I use them as my case study. They export about $950 million worth of cocoa pod to most of the countries like US and Europe. One company alone generates about $17.8 billion. $17.8 billion. That is staggering, from $950 million. So if you're looking at it, we have to put ourselves in a situation where we process it here. I grew up in Silicon Valley, California. I see wealth every day. And most of the material they use to develop most of this technology comes right from Africa. And we are nothing. So these are part of the issues we are looking into with the federal government and also spread it to the rest of Africa.
But do we actually have what it takes to develop these products here?
Well, you have to start. We have what it takes. Nigerians are the smartest people on earth. You can argue that with me. But we just have to create policy that will make it convenient for our people to move forward.
And so what sort of policies will we be
talking
well,
for example, we're looking at the air freight charges we are working on to reduce, because reducing that air freight charges will encourage people to cultivate more, will encourage people to produce more, bring in investors, and all sorts.
And how will this also affect the ground handling companies at the airports, for instance?
Well, looking at it this way, SACOL, for example, for the past few years, they've been busy putting up all the infrastructure needed for agricultural export and other area. The cooling system they have, SACOL have at the airport, completed for the past 2 years, and it's not being used. Why is it not being used? Because the logistic cost is very high. Okay, so SACOL on their own part have done so much in terms of, like showing an eager and interest in improving agricultural export in Nigeria. We are now still waiting on the federal government, which I believe the Buhari administration have addressed. And they brought it to us during the ERGP program. We looked at all the problems and solutions for the problems. And I believe, like I said earlier in the show, that any minute from now, I think Nigerians will have something to smile home about.
And what would you say is the best air freight charge and percentage considerations by the shareholders?
You can't really say, but for now, for us to even up with a lot of countries that we're going to compete with, we're looking at about 90% of what it is today. 90%. But if the government wants to take it one step further, they can even waive it completely, because it must have to be an incentive. Now, let me put it this way. During this COVID-19 period, the aircraft will normally pay for $85,000, jumped to $250,000. And now, at the $85,000, we're finding it very difficult to even compete in the market. Now, talk less about $250,000. But guess what happened? Most of my associates and partners are saying, John, a lot of countries are paying it. Why can't you people pay it? And when I investigated and looked into it, and I found out it was the truth. Something like Ghana, they were paying that $250,000. Here in Nigeria, we can't even pay $85,000. And now we even went further and found out that the farmers and the off-takers were even paying less than $85,000. And the difference, the Ghanaian governments were paying it. To keep the line flowing, you have to keep the system flowing, that you don't create a vacuum. Okay? Now that the COVID-19 issue now is dying down, the rates and the charter rates are dropping.
Would you actually say that the COVID-19 issue is dying down? We have increasing numbers every day.
Well, we have to find a way to live with it. We can't just continue in this form. You understand me? And over the years, we've come up with all kind of problems, all kind of diseases and all that stuff. And the means of living with it came out. So we have to move on.
Now, there's also the request for the establishment of reference points comprising public-private officials across the 6 geopolitical zones. What would be the objective of that?
Well, it's just to create a one-stop shopping for investors. We create a system where the off-takers meet the producers. Okay? Create some kind of sanity and decency in the system. Because as it is right now, agricultural products, in terms of export, it's one word, traceability. As it is right now, no Nigerian product can be traced where it's coming from. And it's very, very key.
And why is that?
Because, you see, I think, let me put it this way, that Nigerians, including me, we hate process. Nobody likes process. Everybody wants to make money the next day. I have so many people coming to me, oh, Captain John, I want to start exporting agricultural product. What do I do? Once you lay down the process of it, they run away. But you see, you have to put that process in place. If you export your product to any nation and there's a need or there's a contamination of any form of disease, you have to trace where it's coming from. You don't need to shut down Nigeria. You don't need to shut down the state. Even the farm where it's coming from, you don't need to shut it down. You go straight to where that point is, isolate it and treat it. And that's what is lacking in Nigeria. So I'm appealing to the government to please empower Nigerian agricultural farmers, empower those people, aggregators that are ready. Now, agricultural export industry in Nigeria can be as high as $250 billion a year. You look at Holland, Holland in Europe, they're about 17 million in population. Their land mass is about 42,000 square kilometers. They're doing well over $400 billion every year. Okay, with 42,000 square kilometers of land mass, Nigeria is 923. If you take Niger State, for example, they're 72,000 square kilometers, almost twice of Holland. What are they exporting? Nothing, zero. So we are looking into all this by setting up that export zones within the Federation. We addressed all these issues. There's so many products in Nigeria that are wanted in the world, but we are not in position to give it to them.
Now, let's talk about the issue of agri-goods standards from Nigeria, which are often rejected at the ports of destination. Now, will the reduction of charges affect issues like this?
Well, the rejection has to do with standards. We don't have it. Everybody believes they can go there, buy yam or buy sesame seed or buy beans and export. No, you have to be able to process yourself. Have a tag, have an identification. People need to know who you are, where it's coming from, what are the sanitary conditions, where this product comes from. Okay, so those are all the factors that you look into. It's not a matter of, okay, like I need to export vegetable. And you can't tell us how where that vegetable is coming from. Nigerian quarantine has a lot of role to play here, and they're playing it. It's just that we Nigerians as people have to be able to sit down and know through that. That's a process. We are human beings. We came into this world through a process. So that's a process that we have to go through, and there's no shortcut for it.
Chief Executive Officer of ABX World, Mr. John Okafor, thanks for coming on Business Morning. It's been a pleasure to have you.
Thank you very much. Thank you.
All right, let's bring you updates from the crude oil markets once again. Of course, prices are down more than 2% this morning, and that's caused by worries about slow demand growth with the coronavirus cases rising. Of course, the U.S. crude stockpiles hitting an all-time high, and the U.S. Federal Reserve projecting recovery from the pandemic would take years. U.S. WTI crude futures raised Wednesday's gains, falling as low as $38.42 a barrel, and Brent crude futures fell 2.2% to $40.81 a barrel, also giving up gains from Wednesday. U.S. crude inventories rose unexpectedly by 5.7 million barrels in the week to June 5 to 538.1 million barrels, and that's a record, as imports were boosted by the arrival of supplies bought by refiners when Saudi Arabia flooded the markets in March and April. And that's from data according to the Energy Information Administration. And the Nigerian Stock Exchange has held a webinar with CEOs of global exchanges on the impact of COVID-19 on the global market and the resilience of securities exchanges in supporting economies. While responding to questions over investments in green bonds, the Chief Executive Officer of the NSE, Mr. Oscar Onyema, explains some of the steps taken so far by the exchange. Let's take a listen.
We've done quite a bit in the ESG space. We started out focusing on the G, governance, really building awareness around governance and creating indices. As you know, we also came up with our corporate governance rating system, really to get corporates focused on that. So that was the first thing we did. Then we moved into the E, environment, right? So we worked with the Ministry of Environment and our Debt Management Office to create the first sovereign green bond on the continent. And we've since seen the sovereign issue a second tranche, and they're now looking at the third tranche. And we've worked with other corporates to come up with corporate green bonds as well, including Access Bank that has listed both on the Luxembourg Luxembourg Exchange and the Nigerian Exchange.
And this brings us to the equities markets review with Temple Ashaju. Good morning, Temple. Tell us, what do you think we should be expecting from the markets yet today?
Well, I think it should still be the sort of sentiment that we saw in the markets yesterday, where there's more of profit-taking. At the same time, we saw some bargain hunting, because if you look at the market sentiment, the market breadth, we saw 19 gainers and 19 losers in the markets yesterday. But if you quickly, before we talk to our analysts, we got a decline of 47 basis points yesterday. This translated to some 66.6 billion naira in terms of what's the equity capitalization of the exchange shared yesterday. Look at the volume of transactions. The largest contributor was Guaranty Trust Bank. It actually gained, but we saw a decline of about 1%, 0.78% specifically yesterday. Value of transactions, GT Bank contributed more than 50% of the turnover that we have here. It did over 1.6 billion naira yesterday in the market, and that's what informed the 183% jump that we have in the value of transactions here. Look at the colors we have around the sectoral performance of the market. The banking stocks were down. We saw some sell-off on Zenith Bank. We saw some other counters experiencing some losses. But Access Bank, for those that are waiting to hear about that, actually gained yesterday. And GT Bank was also one of the key companies or key banks that gained yesterday. Consumer goods side of the market, a lot of those companies that you have under this space were down yesterday due to profits taken specifically. And of course, if you look at the industrial goods segment of the market, we got Kiotics that was down by more than 5%. And Your Toast, Bois Cement, which is offering you some very lovely dividend later in the year, was also down due to profits taken. Insurance space, we got Prestige Assurance, we got Royal Exchange, and of course, a couple of other insurance there that were down, that were positive yesterday. Oil and gas was also positive due to some increase that we saw around the share price of O&O. But if you look at what Japol posted, it was some sort of decline. We should have Philip Anegbe, who is a research analyst with Cardinal Stone Securities, joining us via phone now. Philip, thank you for joining us on the program. Tomorrow is a public holiday, but what direction do you see the markets facing today, given the type of sentiment that we saw yesterday?
Yeah, thank you very much, Temple. We expect the markets to see some more sell-offs today, profit-taking across a few counters. And this expectation is largely hinged on two key drivers. One is increasing inventory build in the oil world, more or less suggesting that the supply glut is still a very big concern. And then you have fears of a second wave of the viral spread in markets across the U.S. and Asia. You expect increased risk sensitivities towards investing in frontier markets like Nigeria. So you may see a net sell-off situation as regards the FPIs. Even domestic players may be a bit more cautious as we move closer to the release of second quarter results, maybe sometime in July.
Right, that's something that we know that a lot of investors will actually be watching out for, especially at the pharmaceutical and healthcare sector space of the Nigerian Stock Exchange, because a lot of those companies quoted in that space have actually been very, very impressive so far this year. They are blazing the trail at this point in time. Philip Anegbe, thank you so much for joining us on the program. Philip Anegbe is a research analyst with Cardinal Stone Securities. Bessie, it's over to you.
All right, Temple, of course, we'll see what direction the market actually faces in a few hours. Stick around, Temple, because you'll come back to tell us what's happening at the debts and currencies market in just a moment. Sure. Plus, we'll also see what's happening in London. Please stay with us. Juliana Olayinka is ready to take us through this morning's business headlines coming from the UK. Good morning, Juliana. So Britain risks entrenching deep class, ethnic, gender, educational, generational, and geographical divides unless the government acts to tackle inequality. How would you relate this report by the Institute for Fiscal Studies this morning?
Good morning, Bissy. That was a big mouthful, wasn't it there? But to note, I would say that we're going through a pretty reflective period in Britain at the moment. There have been so many issues that have come out of this COVID-19 pandemic. And of course, the civil unrest that's happening across the pond has clearly made its way onto British shores. And this new data by the Institute for Fiscal Studies is going to cause more headache for the government, because really what they're doing is highlighting addressing exactly some of the issues that protesters are out on the streets fighting for, and that's inequalities within Britain. And it's not just a race issue, this is a class issue. And what this leading think tank has suggested is that the COVID-19 pandemic has exacerbated these issues, particularly when it comes to the gap between education and the poor and the rich. At the moment, we know that only 7% of pupils are in school at the moment. There are many people that are worried to send their children to school. And even this morning, the opposition Labour leader, Sir Keir Starmer, has written in The Telegraph, which is a pretty highbrow British publication, saying that the government have just not assisted, and that 6 months out of school for people, especially if you're from a lower income, is going to cause a drastic separation and segregation in the future. So it's really interesting. They also suggest that the government need to put in further measures, that it's not just the furlough and the subsidy wage scheme that's going to remove this gap. They also suggest that a lot of people on lower wages are the ones that are at risk of losing their jobs. And as you know, because we have discussed it on channels over the past couple of months, we have seen that black people and those from ethnic minority backgrounds are disproportionately affected by COVID-19. So, it's a lot of calls for thought for the government. There are lots of reflections going on at the moment. But of course, the fact that this leading think tank has reaffirmed much of the sentiment that's going on should be pretty worrying for Boris Johnson, I would say.
Juliana, an IOD survey shows that businesses have dramatically scaled back investment plans for the rest of the year in response to the uncertainty surrounding the future of the UK economy. But it looks like firms are more interested in their own recovery rather than the broader economy.
Absolutely. I think that's the case across the world. If your business recovers, then of course the economy recovers. I think that's exactly how it is. And the Institute of Directors, they always do these monthly surveys where they talk to the biggest business leaders across the world, across Britain, but particularly in the city. And their data reveals that although the sentiment about confidence in the economy is slightly growing, new employment and investment is definitely very much on hold. A lot of companies are not sure whether or not investing in new projects and getting more people into your team is exactly the right thing to do at the moment. And what the IOD is suggesting is that the government do offer more tax breaks for some of these big companies, do give them more incentives to start employing people, because as we know, and what the fear is that as soon as this furlough scheme ends at the end of October, there will be mass unemployment. We already heard from the British gas owner Centrica just this morning that they will be releasing 5,000 jobs. We've seen it from the airline industries and so many other industries, even though they're furloughing their employees at the moment, still plan to make many people redundant. So this is just yet another warning to the government that the sentiment at the top is that, they're going to be putting a hold on bringing more people into their offices.
Let's talk about food now, Juliana. Food delivery app Just Eat Takeaway has agreed to buy U.S. rival Grubhub in a $7.3 billion deal. Just Eat Takeaway was created by the merger of the UK's Just Eat and the Netherlands-based Takeaway. What would this mean for the company?
Well, what this means is that they're going to be a major player. In fact, if this $8 billion deal does go ahead, and it seems as if it will, they would be the biggest world food online delivery app outside of China. If this deal does go ahead with Grub, which I believe is a Chicago-based delivery app, then they would be able to operate out of 23 countries, the biggest countries being Britain, the Netherlands, Belgium, and America. And it's a win-win for them. They've been doing a media rounds. I believe they were, one of the CEOs was speaking to the Financial Times this morning, and they said, look, of course we wouldn't have wanted to go so soon at Grub, just months after we already spent $8 billion merging with Just Eat, but it's good for the business. Of course, we know during the pandemic, because people have been shut down, most people that can't go out to their favorite restaurants have been ordering online, and it is a very very competitive industry. I believe just a couple of months ago, Uber Eats did try to get Grub, didn't exactly work out. There's also a German delivery app called Hero. They also wanted to try and get their hands on Grub. That also didn't work out. But, within 3 weeks, Just Eat Takeaway managed to pull together some sort of proposal that the Grub operators just couldn't turn down. So yes, if they do it, this would be one of the world's biggest online delivery takeaway apps in the world. Thanks, Bissy.
Thank you, Juliana. We'll see you again later, and enjoy the rest of your day.
Okay.
And it's back now to Temple Ashadu to take us through the debt and currencies market. Over to you, Temple.
Thank you, BC. Well, before we talk about the debt and currency market, look at what we have at the unlisted securities end of the market. There was no change yesterday. This is a market that looks to be backtracking gains recent times, because if you look at the capitalization, it is now 501 billion naira so far. Of course, there's a public holiday tomorrow, so perhaps there won't be too much difference today today when the market opens. But look at volume of transaction, 88,000. VFD Group, which had 99% of these, was responsible for these numbers that you have on the screen. 9 point something million naira was actually exchanged in that. And of course, you have Afriland, and 100 million units of the shares traded yesterday. For the debt and currency side of the markets, things were really quiet yesterday. We got a lot of investors checking out the 27th of April 2023. Not so much actually, because yields at the end of the day expanded by 1 basis point according to the coverage that we have, and just a little bit of interest on the 14th of March 2024 paper. There was basically no activity on the entry TB side of the market yesterday, as investors and dealers, treasurers all moved attention to the primary market auctions carried out by the central bank. Again, there's some sort of tight system liquidity lately. At the open market operations, the deals tells you what we had, just 20 deals yesterday, and that explains the bearish sentiment that we're seeing. A bit of interest around the mid to the longer end of the curve lately, especially on the February paper, the extrapolated versions of February 2021 paper, where we saw a lot of activities. But we have Lauren Toba, showing me more fixed income dealer with FSDH Merchant Bank, joining us on the phone. Lauren Toba, thank you so much for joining us on the program. But we know that system liquidity opened at around 136 billion naira yesterday, but there will be no much of inflows today and no maturities. Talk to us about the direction of the market.
Hi, good morning. Thanks for having me. Well, despite the tight liquidity in the system, we have seen that there's still been a lot of investor appetite in the market. We can see that from the result of the auction conducted by the DMO yesterday. Rates trended down a bit, so we expect that demand will still be sustained.
So quickly before we go, can you unpack the details of the DMO auction, 90.4 billion naira yesterday?
So the auction yesterday, we had a total amount of 90.94 billion offered. The same amount was sold. It was oversubscribed, 176.94 billion. The rates dropped lower. The 91 days dropped by 45 basis points to close at 2%. The 364 days remained relatively flat at 4.02%, while the 182 days recorded the largest drop by 52 basis points to close at 2.2%, a 32 basis point average drop. We expect to see that demand even within the coming days and weeks.
Okay, so any idea what is likely to change on the Treasury bill side of things today? I mean, there was no movement yesterday. It was all flat.
So we expect to see, like I said, the demand. There has been demand. We expect that demand to continue. The CBN has announced a normal auction today, 60 billion on offer. Assuming that they sell just that amount on offer, we expect to see rates depress. And honestly, that is the trend that we expect to see going forward. Demand has been sustained for a couple of weeks, so we expect that demand to keep on getting stronger.
So there's also a sense that we got yesterday, Lauren Toba, about the FX market. I know you are more of a fixed income dealer, but I bet you can tell us about that as well. There seemed to be some kind of increase in volume of transactions at the I&E window yesterday. Do we know what actually informs that sentiment?
I can't say categorically which transaction it is, but I know that the central bank and customers, there has been a lot of inflows into the market, so we expect to see much more activity in that space.
Perhaps the crude oil price is actually shaping out things for us
It's
on that side of the
well.
market.
It's
Olorun
helping a lot.
Tobashuwemi, more fixed income dealer with FSDH Merchant Bank. Thank you for your comments. Busy. I guess it's time to go offline. Huh?
Yes, indeed, Temple. And of course, the markets will be closed tomorrow for the public holiday. So we'll see the markets resume again on Monday. And that's where we end today's program. Thank you for watching. I am BC Adebayo. Bye for now.